Before we dive in, a quick but important note. I am not a financial advisor, and this presentation is for informational and educational purposes only. The information provided in this video does not constitute financial, legal, or tax advice. You should always consult with a licensed and qualified professional for advice tailored to your individual situation before making any financial decisions. Your financial future is your responsibility, so please do your due diligence. Now let's talk about the biggest financial mistake you can make with your home. It's not overpaying for the house. It's not choosing the wrong paint color. It's choosing the wrong way to pay for that dream kitchen or that badly needed new roof. Picture this. A couple, we'll call them Mark and Jessica, finally buy a home in a great neighborhood. It's perfect except for the master bathroom, which looks like it was teleported directly from 1987. We're talking pink tile, a leaky faucet, and lighting that makes everyone look like a zombie. They get a quote for a full remodel, $35,000. They're excited. They want it done fast. A contractor mentions a quick and easy personal loan he can connect them with. No appraisals, no mountains of paperwork. They sign on the dotted line, and 2 months later they have a stunning spa-like bathroom. They're thrilled. Fast forward 1 year. The high, fixed monthly payment on that personal loan is starting to feel like a lead weight. A new job opportunity comes up in another state. A true dream job for Jessica. They decide to sell the house. But when they get the home valued, they discover a brutal truth. The $35,000 bathroom only added about $15,000 in value to their home. And because they used a personal loan, that $35,000 debt is completely separate from their house. It doesn't just disappear when they sell. They now have to sell their home, pay off the mortgage, and still be on the hook for another $28,000 on a bathroom they don't even own anymore. They're trapped. Their dream project became a financial prison. This story isn't an exaggeration. It happens every single day across America. And the difference between Mark and Jessica's nightmare and you building real, tangible wealth from your home project comes down to one single decision: choosing the right financial tool for the job. You wouldn't use a sledgehammer to hang a picture frame, so why would you use the wrong type of loan to build your future? That's exactly what this video is about. This is your definitive guide to the two heavyweights of home project financing: tapping into your mortgage versus taking out a personal loan. We are going to cut through all the confusing bank jargon, all the misleading sales pitches, and give you a crystal clear framework to make the right choice. By the end of this, you won't just understand the difference between a cash-out refinance and a personal loan. You will know with absolute certainty which one is the smart, wealth-building move for your specific project, your budget, and your life. Making the wrong choice can cost you tens of thousands of dollars, trap you in your home, and vaporize your hard-earned equity. But making the right choice, that can unlock the hidden value in your home, increase your net worth, and turn your property into a true financial asset that works for you. The stakes are incredibly high, and most people don't even realize they're walking through a financial minefield. So where do we start? We start by forgetting about interest rates for a second. Yes, they're important, but they are not the first thing you should look at. The very first, non-negotiable question you must answer is this: what is the scale and purpose of my project? This seems obvious, but this is where the first mistake is made. You need to categorize your project into one of two buckets: a repair and enjoy project, or a renovate and invest project. Let's break that down. A repair and enjoy project is typically smaller, costing anywhere from a few thousand to maybe $15,000. Think about things like a new water heater, fixing a leaky roof, replacing a broken garage door, or even a small cosmetic update like repainting the entire interior. The primary goal here is maintenance, necessity, or immediate enjoyment. You're not fundamentally transforming the value of your home. You're keeping it in good shape or making it more livable for yourself right now. For these smaller, repair and enjoy projects, a personal loan can often be the smarter, faster, and more logical choice. Why? Simplicity and speed. A personal loan is an unsecured loan, which means you're not putting your house up as collateral. The bank is lending you money based on your creditworthiness, your credit score, and your income. The application process is often entirely online and can take minutes. You can get approved in a day and have the cash in your account within a week. There are no appraisal fees, no origination fees that run into the thousands, and no complicated closing process. You're essentially trading a potentially higher interest rate for incredible speed and convenience. If your air conditioner dies in the middle of a July heat wave, you don't have 2 months to wait for a cash-out refinance to be approved. You need cash and you need it now. A personal loan is the financial equivalent of an emergency toolkit. It's fast, efficient, and perfect for a specific urgent job. The repayment term is also short, usually 2 to 7 years. So you pay it off quickly and move on with your life without having that debt lingering for decades. Now let's talk about the other bucket, the Renovate and Invest project. This is the big one. This is your $50,000 kitchen gut job, your $80,000 master suite addition, your $100,000 project to finish the basement and add a bathroom. These are projects that fundamentally change the square footage, the functionality, and most importantly, the market value of your home. You're not just repairing something. You are making a significant capital investment in your single largest asset. And for these large-scale, investment-grade projects, using a personal loan is almost always a catastrophic financial mistake. It's like bringing a knife to a gunfight. This is where your mortgage becomes your single most powerful financial tool. Why? It comes down to 3 critical factors: cost of capital, loan terms, and tax advantages. Let's start with the cost. When you tap into your mortgage through something like a cash-out refinance or a home equity line of credit, a HELOC, you are getting a secured loan. Your house is the collateral. For the bank, this is a much lower risk than an unsecured personal loan. And lower risk for the bank means a much lower interest rate for you. We're talking a potential difference of 5, 7, even 10% or more. On a $75,000 loan, that difference can literally add up to tens of thousands of dollars in interest payments over the life of the loan. It's a massive, undeniable savings. Second, the loan terms. A personal loan demands to be paid back quickly, resulting in high monthly payments that can suffocate your cash flow, just like it did for Mark and Jessica. But when you roll that $75,000 into your mortgage, you're spreading that cost over a much longer period, typically 15 or 30 years. This results in a dramatically lower, more manageable monthly payment. It gives your budget breathing room. Yes, you'll pay more in total interest over 30 years than you would over 5, but you're treating the project for what it is: a long-term investment, not a short-term expense. You're matching the financing timeline to the asset's lifespan. And third, the potential tax advantages. The interest you pay on a mortgage or a home equity loan can often be tax deductible if you use the funds to buy, build, or substantially improve the home that secures the loan. That personal loan, the interest you pay on that is almost never tax deductible. This is another way the U.S. tax code incentivizes homeowners to invest in their properties using their home's equity. It's a direct financial benefit that you are leaving on the table if you opt for a personal loan on a major renovation. So the first filter is simple. Small project under $15,000, focused on urgent repairs or quick cosmetic fixes. A personal loan is a strong contender. Large project over $20,000, focused on adding significant long-term value? Using your mortgage is almost certainly the only smart path forward. Getting this first step right is half the battle. It immediately eliminates the wrong choice and sets you on a path to financial success instead of regret. Let's talk about that regret. Imagine 2 neighbors both on the same street, both with the same dream: a stunning new kitchen. Neighbor A, let's call him Tom, gets impatient. He sees a flashy ad for a quick personal loan, signs on the dotted line, and has his new kitchen in 6 weeks. Neighbor B, we'll call her Jessica, takes a different route. She understands the power of her home's equity. She takes a few extra weeks to work with her mortgage lender. A year later, Tom is drowning in a high-interest short-term payment that eats up his entire fund budget. His kitchen is a source of stress. Jessica, on the other hand, barely notices her slightly higher, long-term mortgage payment. Her kitchen is a source of joy and has already increased her home's value by more than she spent. They both got the kitchen, but only one of them got financial peace of mind. The difference wasn't the kitchen. It was the financial tool they used to build it. This is the power of choosing the right path. So, when you decide to use your mortgage, you're not just using your mortgage. You're tapping into your home's equity. Think of equity as the portion of your home you actually own. It's the market value of your house minus what you still owe on your loan. If your home is worth $400,000 and you owe $250,000, you have $150,000 in equity. This is a powerful financial asset, and there are 3 primary ways lenders let you access it for a big project: the home equity loan, the home equity line of credit, and the cash-out refinance. Each one is a different tool for a different job, and picking the wrong one can be just as bad as choosing a personal loan in the first place. Let's start with the simplest: the home equity loan, often called a HEL. The best way to think of this is as a second mortgage. You're taking out a completely separate, new loan against the equity in your home. Let's say you need exactly $50,000 for a basement remodel. You go to the bank, they approve you for a $50,000 home equity loan, and they deposit that entire amount into your bank account as a single lump sum. From that point on, you have 2 monthly payments to make, one for your original primary mortgage and a second new payment for your home equity loan. The beauty of a HEL is its predictability. It almost always comes with a fixed interest rate. So if you get a 15-year loan at 7%, that payment will be the exact same every single month for 15 years. No surprises. This makes it a fantastic choice for people who live by their budget and need absolute certainty. You know the exact cost of your project, you get the money up front, and you know your exact payment until it's paid off. It's clean, it's simple, and it's stable. The downside? You start paying interest on the full $50,000 from day one, even if your contractor won't need the final $10,000 for another 6 months. And just like your first mortgage, it has closing costs, which can be a few percent of the loan amount. Now let's look at its more flexible cousin, the home equity line of credit, or HELOC. If a home equity loan is a second mortgage, a HELOC is best described as a credit card for your house. It's a revolving line of credit. Instead of getting a lump sum of $50,000, the bank approves you for a credit limit up to a certain amount, say $75,000. But your balance is zero. You don't owe anything until you actually use it. A HELOC is typically broken into 2 phases. First is the draw period, usually about 10 years. During this time, you can pull money out as you need it, just like a credit card. Your contractor needs $15,000 for demolition and framing? You transfer it over. A month later, they need $20,000 for plumbing and electrical? You transfer that. You only pay interest on the amount you've actually withdrawn. If you only use $35,000 of your $75,000 limit, you only pay interest on $35,000. This flexibility is incredible for projects where the final cost is uncertain. Think of a major gut renovation where you might find unexpected problems behind the walls. A HELOC gives you the cushion to handle those surprises without panic. But this flexibility comes with a catch, and it's a big one. The interest rate is almost always variable. It's tied to a benchmark rate like the prime rate. So if the Federal Reserve raises interest rates, your HELOC payment will go up. It lacks the stability of a home equity loan. After the draw period ends, the repayment period begins. You can no longer withdraw funds, and you have to start paying back both the principal and the interest, usually over the next 15 or 20 years. Finally, we have the heavyweight champion of home financing, the cash-out refinance. This one is the most misunderstood, but in the right situation, it's the most powerful. A cash-out refi doesn't add a second loan. Instead, it completely replaces your existing mortgage with a brand new, larger one. Let's go back to our example. Your home is worth $400,000 and you owe $250,000. You need $50,000 for that big addition. With a cash-out refinance, you would take out a new mortgage for $300,000. The first $250,000 of that new loan immediately pays off and eliminates your old mortgage. The remaining $50,000 is given to you in cash, tax-free. Now, you're back to having just one single mortgage payment each month. So, when does this make sense? There's really only one golden scenario. When current mortgage rates are significantly lower than the rate on your existing mortgage. Imagine you bought your house when rates were at 6.5%, but now they've dropped to 4.5%. By doing a cash-out refi, you can pull out that $50,000 for your project and lower the interest rate on your entire mortgage balance at the same time. It's like the bank is paying you to renovate your home. It's a brilliant move. However, if rates are higher now than when you got your original loan, a cash-out refi is almost always a terrible idea. You'd be taking out cash, yes, but you'd be raising the interest rate on your entire $300,000 debt, costing you tens of thousands of dollars more over the life of the loan. You're also resetting the clock. If you were 10 years into a 30-year mortgage, a new 30-year refinance means you'll be paying for your home for a total of 40 years. It's a massive long-term decision. So let's recap the battle plan. The home equity loan. A lump sum, a fixed rate, a predictable payment. Perfect for the project with a known one-time cost. The HELOC. A flexible line of credit, a variable rate, pay as you go. Ideal for projects with uncertain costs or multiple phases over time. And the cash-out refinance. A brand new mortgage, one single payment. The ultimate power move, but only if you can lock in a lower interest rate than you have now. Each tool is designed for a specific job. Using a HELOC for a fixed-cost project might expose you to unnecessary interest rate risk. Using a home equity loan for a sprawling renovation could leave you short on cash when an unexpected problem arises. Choosing the right tool isn't just about getting the money. It's about structuring the debt in a way that aligns with your financial life and risk tolerance. It's about making your home's equity work for you, not against you. And that brings us to the most important part of this entire discussion. We've talked about the mechanics, the how-to, but we haven't talked about the hidden traps. The slick marketing phrases lenders use, the fees buried in the fine print, and the one cognitive bias that causes more homeowners to go bankrupt from these loans than any other reason. Before you even think about picking up the phone to call a lender, you need to understand these dangers. Because falling into even one of them can turn your dream renovation into a financial catastrophe that haunts you for decades. And that is exactly what we are going to expose next. Let's start with the siren song of the personal loan. It's fast. It's simple. You can often get approved online in minutes with cash in your bank account in a day or two. There's no mountain of paperwork, no appraisal, no lien on your home. Feels clean. Feels modern. Feels like the path of least resistance. And that, right there, is the first and most seductive trap. Because in finance, the path of least resistance is almost always the most expensive. The first danger is what I call the interest rate illusion. A lender might offer you a personal loan for your $40,000 bathroom remodel at, say, 11.99%. It looks like a clear, honest number. But what you're not immediately comparing it to is the alternative. That same month, a home equity loan might be available for 6%. Your brain sees 11.99 and 6 and knows one is bigger. But it doesn't immediately calculate the catastrophic difference over time. Let's do the math. On that $40,000 personal loan at 12% for 5 years, your monthly payment is about $890. Over the life of the loan, you'll pay back a staggering $53,400. That's $13,400 in pure interest. You didn't just pay for new tile and a vanity. You paid for a phantom bathroom, built entirely out of interest payments that you will never get to use. Now let's look at that same $40,000 through a home equity loan at 6%, but let's stretch the term to 15 years to make the payments even lower. Your monthly payment would be just $337. That's over $500 a month back in your pocket. Cash you can use for groceries, for gas, for saving. And the total interest paid over those 15 years? Just over $10,800. So even over a term that is 3 times as long, you still pay thousands of dollars less in interest. The fast and easy personal loan cost you an extra $13,000 and strangled your monthly cash flow to do it. That's the interest rate illusion. It's a tax on impatience. The second danger is the myth of the unsecured loan. This is the biggest selling point for personal loans. Your house isn't at risk, they say. It's unsecured. This sounds like a safety net. Feels responsible. It is, in fact, one of the most misleading ideas in consumer finance. While it's true they can't immediately foreclose on your home, don't you dare think for a second that your assets are safe. Because the loan is unsecured, lenders have to be far more aggressive and creative when you miss a payment. Their playbook isn't foreclosure. It's a direct assault on your life. First, your credit score isn't just damaged, it's nuked from orbit. A single default on a personal loan can drop your score by over 100 points, slamming the door on any decent loan for the next 7 years. But it gets worse. Once you've missed enough payments, they won't send a polite letter. They will sue you. And when they win, and they almost always win because you did, in fact, borrow the money, they get a court judgment. This judgment is a golden key that unlocks your entire financial world. With it, they can legally garnish your wages. That means they go directly to your employer and take a chunk of your paycheck before you even see it. Imagine explaining that to your boss. They can levy your bank accounts, freezing them and sucking out whatever cash is in there without your permission. Your rent money, your emergency fund, gone. They can even seize assets in some states. The unsecured loan doesn't mean you're safe. It just means the lender takes a different, often more brutal and humiliating, path to get their money back. It's not a threat to your house. It's a threat to your income, your savings, and your professional reputation. This brings us to the third danger: repayment rigidity. Personal loans are almost always short-term. We're talking 3, 5, maybe 7 years max. This is a feature, not a bug, for the lender. A shorter term forces a higher monthly payment, which means they get their money back faster, reducing their risk. But for you, it's a financial straitjacket. Let's go back to our $40,000 loan. The 5-year personal loan demanded $890 a month. That is a massive inflexible bill. What happens if you have a medical emergency? What if your car breaks down? What if you or your spouse loses a job for a few months? That $890 payment doesn't care. It's a relentless monster that shows up on the first of every month, ready to eat. There's no wiggle room. You can't just pay the interest for a month. You can't re-amortize it. You either pay it, or you trigger the cascade of wage garnishments and credit destruction we just talked about. That high, rigid payment creates a cash flow crisis. It forces you to live closer to the edge. The home equity loan, with its $337 payment, gives you breathing room. It gives you resilience. The personal loan takes it away. It bets everything on your life going perfectly for the next 60 months straight, with no surprises. And let's be honest, whose life is ever that predictable? Finally, there's the fourth and most insidious danger, the debt stacking phenomenon. Because personal loans are so easy to get, they feel like an ATM. You finish the bathroom and realize the kitchen looks dated, so you take out another $15,000 personal loan. Then the floors need redoing. Another $10,000. Before you know it, you're not managing one loan. You're juggling 3 separate personal loans, each with its own high interest rate, its own due date, and its own crushing monthly payment. This is how the debt spiral begins. Your total monthly outflow for these simple loans is now approaching $2,000. That's more than a mortgage payment for many people. To make ends meet, you start putting groceries on a credit card. You float the electric bill on another. The high payments from the loans are creating new, even higher interest debt. You are now borrowing money just to manage the payments on the money you already borrowed. It's a chaotic, stressful nightmare. You started this journey wanting to improve your home, to build a sanctuary. But by choosing the easy path, you've accidentally turned your finances into a war zone. You're constantly moving money around, fighting to stay afloat, terrified of missing a payment. The dream of a new kitchen has been replaced by the very real nightmare of a financial collapse. These 4 dangers, the interest rate illusion, the unsecured myth, repayment rigidity, and debt stacking, are the hidden teeth in the seemingly harmless personal loan trap. They prey on our desire for speed and simplicity, and they have the power to derail not just your renovation project, but your entire financial future. Now, hearing all this, you might be thinking the answer is obvious. Just use the equity in your home. It's cheaper, it's more flexible, it's the clear winner. But if the personal loan is a minefield, a mortgage-backed loan is a tightrope walk over a canyon. The rewards are greater, but the consequences of a single misstep are absolute. Because here you aren't just risking your credit score or your paycheck. You are risking the roof over your head. And the ways you can lose it are more numerous and more subtle than you could ever imagine. Let's start with the most insidious one because it's the one that feels the safest. It's the home equity line of credit, the HELOC. The bank makes it sound so simple, so flexible. It's like a credit card, they say, but backed by your house, so the interest rate is way lower. And for a while it is. They give you a 10-year draw period, where you can pull out money as you need it for your project, often only paying the interest on what you've borrowed. Feels like free money. You're renovating the kitchen, paying a low monthly bill, and everything is perfect. But what they don't scream from the rooftops is what's written in the fine print. That low interest rate? It's almost always a variable rate, tied to the prime rate set by the Federal Reserve. For years, when rates were near zero, this was a gentle sleeping giant. But when the economic winds shift, that giant wakes up, and it is starving. Your introductory low rate expires, and suddenly your monthly payment is tethered to the most volatile economic indicator in the country. A 1% hike in the prime rate doesn't sound like much, but on a $100,000 balance, that's an extra grand a year. A 2% hike? $2,000. And it keeps climbing. The payment that was a comfortable $300 a month can swell to $700, then $1,000, then $1,200. Your budget, once perfectly balanced, is now shattered. You're not just paying for your kitchen anymore. You're paying for macroeconomic policy decisions made in a boardroom 1,000 miles away. And that's before the real trap springs. At the end of that 10-year draw period, the loan enters the repayment period. The rules change overnight. You can no longer borrow from the line of credit, and your payment structure is completely recalculated. Now you have to start paying back both the principal and the interest, usually over a 15 or 20-year term. That comfortable, interest-only payment you got used to? It's gone. It's replaced by a fully amortized payment that can easily be double or triple what you were paying before, even if interest rates stayed the same. If they've gone up, the payment shock is catastrophic. It's a ticking time bomb, set a decade in the future. and the bank just handed you the detonator and called it flexible financing. But that's just one path to ruin. Let's talk about a clause so predatory it should be illegal. It's called cross-collateralization. If you get your home equity loan from the same bank where you have, say, a car loan or a credit card, you must read every single word of your agreement. Because some lenders slip in a cross-collateralization clause. In plain English, this means they are legally bundling your debts. They are using the most valuable asset you own, your home, as security for all of your loans with them. Think about the implications. You've paid your mortgage and your home equity loan on time, every single month without fail. But you have a tough month. You lose a big client, the transmission goes out on your car, and you're late on your car payment. Or maybe you max out your credit card from that same bank due to a medical emergency and you miss a payment. With a cross-collateralization clause in effect, the bank can declare you in default on your entire relationship with them. And because your home is now collateral for that car loan or that credit card, they can begin foreclosure proceedings on your house. You read that right. Missing a $500 car payment could trigger the legal process that costs you your $300,000 home. It is the financial equivalent of a hidden tripwire connected to a nuclear bomb. And it gets worse. Have you ever heard of a call provision? It's another venomous little detail buried in the legal jargon of some home equity agreements. A call provision gives the lender the right to demand the entire balance of your loan be paid back immediately, in full. They can call the loan. Now, they can't do this just because they feel like it. But the triggers for it are terrifyingly broad. A significant drop in your home's value during a housing market downturn? That can be a trigger. A major change in your financial situation, like a job loss, even if you're still making the payments? That can be a trigger. The bank's own financial health declining, forcing them to reduce their risk profile? Believe it or not, that can be a trigger. Imagine getting a certified letter in the mail one day. It's not a bill. It's a demand. You owe $85,000, and you have 30 days to pay it. If you can't, they foreclose. You can't reason with them. You can't explain that you've been a perfect customer. The contract you sign gives them the right. It's an eject button and you're in the pilot seat, but their hand is on the control. Now let's pivot to the cash-out refinance. This is often sold as the cleanest, simplest option. You're not getting a second loan. You're just replacing your old mortgage with a new, bigger one and taking the difference in cash. It's one payment, one lender, nice and tidy. But the danger here isn't hidden in a clause. It's hidden in plain sight, in the math that people refuse to do. Let's say you bought your house in 2021 with a 2.75% interest rate. That rate is more than a number. It is a golden ticket. It is one of the most powerful wealth-building tools you will ever possess. Over 30 years, the amount of interest you pay is minimized, allowing more of your payment to build equity. Now it's a few years later. You need $50,000 for an addition. A lender offers you a cash-out refinance. You'll get your $50,000, and your new rate will be 6.5%. What have you just done? You didn't just borrow $50,000 at 6.5%. You took the remaining $250,000 of your original, beautiful 2.75% mortgage, and you voluntarily refinanced that at 6.5% as well. You have vaporized your single greatest financial advantage. You have taken a cheap, simple debt and transformed it into an expensive, colossal one. The extra interest you will pay over the life of this new loan won't just be on the $50,000 you borrowed. It will be on the entire loan amount. We're talking about an additional $100,000, $150,000 or more in pure interest payments over 30 years. All for $50,000 in cash today. It's like burning down your house to roast a pig. In every single one of these scenarios, the HELOC payment shock, the cross-collateralization trap, the called loan, the catastrophic math of the cash-out refi, the end result is the same if you can't pay. It's a word we hear, but we don't truly comprehend its brutal mechanics. Foreclosure. This isn't like missing a credit card payment, where you get annoying phone calls. This is a legal, methodical process of seizure. First comes the notice of default, a formal public declaration that you have failed. Then the lawyers get involved and their fees are tacked onto the mountain of debt you already owe. The bank will give you a window of time, a redemption period, to somehow come up with all the money you owe, plus penalties and legal costs. For 99% of people, this is impossible. And when that clock runs out, they set a date. An auction date. A day when a stranger will stand on the steps of your local courthouse and sell your home, your memories, your kids' height charts on the doorframe, to the highest bidder. And if there's one final, cruel twist of the knife, it's this. In many states, if the home sells at auction for less than what you owed the bank, which often happens in a forced sale, the bank can still come after you for the difference. It's called a deficiency judgment. So not only are you homeless, but you still have a bill for a house you no longer own. This is the absolute power the bank holds when you sign on that dotted line. You are not just a customer. You are a risk they are managing. And the collateral is everything. So what does that mean for you, the homeowner, who just wants to build a new deck or finally finish the basement? It means that this collateral, the very walls around you, is also your greatest financial asset. It's a source of immense potential power, if you know how to unlock it. This is where the concept of a mortgage evolves from a simple home loan into a sophisticated financial tool. The key to that lock is a single word: equity. Home equity is one of those terms that gets thrown around a lot, but most people only have a vague sense of what it truly is. Let's make it crystal clear. Imagine your home is a giant pie. When you first bought it, the bank owned almost the entire pie. You just had a tiny sliver. Every single mortgage payment you make is you slowly, methodically buying another slice of that pie from the bank. At the same time, if the housing market is doing well, the entire pie is getting bigger. Your equity is simply the part of the pie that you own. It's the current market value of your home, minus the amount you still owe to the bank. If your home is worth $500,000, and you still owe $300,000 on your mortgage, you have $200,000 in home equity. It's not cash. You can't go to the ATM and withdraw it. It's wealth trapped in the bricks and mortar of your house. It's a number on paper, but it's a very powerful number, because banks are willing to give you a second loan, a new key to unlock a portion of that value. And this is where we meet the two main characters on the mortgage side of our story: the home equity loan and the home equity line of credit. Think of them as two brothers. The home equity loan, or HELOC, is the older, more responsible brother. He's predictable, stable, and a little bit rigid. When you take out a home equity loan, you're borrowing a single lump sum of cash against your equity. Let's say you need $75,000 for a complete kitchen remodel. You've got the contractor quotes, you know the exact cost. You go to the bank, you get approved for a $75,000 home equity loan. They wire that money directly into your account. Boom, it's done. From that moment on, it works just like a car loan or your original mortgage. You have a fixed interest rate that will never change. You have a fixed monthly payment that will never change. And you have a fixed term, usually something like 10 or 15 years, to pay it back. You know to the penny what that kitchen will cost you every single month until it's paid off. This predictability is its superpower. In a world of financial uncertainty, a home equity loan is a rock. It's perfect for massive, one-time projects where the budget is set in stone. A new roof, a swimming pool installation, a down payment for an investment property. You get the money, you do the project, you pay the steady, predictable bill. But that rigidity is also its weakness. What if you only ended up needing $65,000 for that kitchen? Tough. You still borrowed $75,000, and you're paying interest on all of it. Or, what's more likely in the world of home renovation, what if the contractor opens up a wall and finds a massive problem, and the cost suddenly jumps to $90,000? Well, the home equity loan can't help you. You only got $75,000. You'll have to scramble to find that extra $15,000 somewhere else. There's no flexibility. It's a one-and-done transaction. Now let's talk about the younger brother, the home equity line of credit, or HELOC. He's flexible, adaptable, and a little bit unpredictable. A HELOC doesn't give you a lump sum of cash. Instead, the bank approves you for a maximum credit limit based on your equity, say $100,000. They then hand you what is essentially a credit card or a checkbook tied to that account. It's a revolving line of credit. For your project, you only use what you need when you need it. So, the demolition for the kitchen costs $10,000. You write a check from your HELOC. The new cabinets are $15,000. You swipe the HELOC debit card. You only pay interest on the money you've actually taken out. If your project comes in under budget, fantastic. You never borrowed that extra money, so you never have to pay interest on it. If the contractor finds that surprise problem behind the wall, it's not a panic moment. You just draw more from your available credit line to cover it. This incredible flexibility is what makes HELOC so popular for projects with uncertain costs or long, drawn-out phases. You're not guessing what the final bill will be, you're paying the bill as it comes. But this is where the younger brother's unpredictable nature comes into play. Most HELOCs have a variable interest rate. This is critical. It's not fixed like a home equity loan. It's tied to a benchmark rate, like the prime rate set by the big banks. If the Federal Reserve raises interest rates to fight inflation, the interest rate on your HELOC balance will go up too. Your monthly payment isn't stable, and it will fluctuate. You might start out with a temptingly low introductory rate, but a few years down the line you could be paying significantly more. And there's another even bigger catch. A HELOC is structured in two parts: the draw period and the repayment period. The draw period is usually the first 10 years. During this time, you can borrow money from the line of credit as you please. Often, your required monthly payments are very low. Sometimes they're interest-only payments. This feels amazing. You're funding a huge renovation and your monthly bill is tiny. But then the draw period ends. The party stops. You can no longer borrow any more money, and your account switches to the repayment period. Whatever balance you have outstanding is converted into a fully amortizing loan, meaning you now have to pay back both principal and interest over the remaining term, say 20 years. This is called payment shock, and it is a very real danger. People who were comfortably paying a few $100s a month in interest-only payments can suddenly be hit with a bill for $1,000 or more as they're forced to start paying down the principal at a market interest rate. It can be financially devastating if you're not prepared for it. And because it's so easy to use, just a swipe of a card, the temptation to use a HELOC for things other than home improvement is immense. A vacation, a new car, consolidating credit card debt. But here's the trap. The Tax Cuts and Jobs Act changed the rules. The interest you pay on home equity debt is now only tax deductible if the money was used to buy, build, or substantially improve the home that secures the loan. So if you use your HELOC to pay off your credit cards, not only are you putting your house on the line for that debt, you can't even deduct the interest anymore. You're taking all the risk for a fraction of the old reward. Ultimately, both the steady HELOC and the flexible HELOC are powerful tools. But they are both at their core second mortgages. They use your home as collateral. If you fail to make the payments on that new kitchen, the bank doesn't just repossess your countertops. They can initiate foreclosure proceedings and take your entire house, selling it to pay off both your original mortgage and your home equity debt. The stakes are exactly the same. You are leveraging the roof over your head. So you have these two powerful but deeply serious options tied directly to your home. But what if there was another way? A way to get the cash you need for a project without adding another lien on your property? Without putting your home on the line every single time you write a check to a contractor? That's where the personal loan enters the arena. And its story is completely different. The personal loan is the agile specialist. It's the financial tool that walks into the room with no baggage. It doesn't care about your home's estimate, it doesn't need an appraisal, and it certainly doesn't ask for a key to your front door. A personal loan is, at its core, an unsecured installment loan. And those two words, unsecured and installment, are the keys to understanding its entire philosophy. Let's break that down. Unsecured is the game changer. Unlike a mortgage, a cash-out refi, or a HELOC, a personal loan isn't backed by any collateral. The lender isn't holding the deed to your house as a safety net. They aren't putting a lien on your property. Their decision to lend you money is based on one thing and one thing only: their faith in you. It's based on your credit history, your income, and your ability to repay. It's a loan based on your reputation, not your real estate. This fundamentally changes the relationship between you and the lender, and it completely alters the risk profile for you, the homeowner. You are not betting the house, literally. If in a worst-case scenario you default on the loan, the bank can't foreclose. They can damage your credit for years, they can take you to court, they can garnish your wages. It's incredibly serious, but they cannot seize your home over it. For many people, that distinction is the single most important factor. It's the difference between a sleepless night and a good one. The second part is installment. This means you get the money in one lump sum, and you pay it back in equal fixed monthly payments over a set period of time. There's no guesswork. If you borrow $20,000 for 5 years at a 9% interest rate, you know your payment will be exactly $415.17 every single month, from the first payment to the 60th and final payment. It's predictable. It's simple. It's a stark contrast to a HELOC, where your payment can fluctuate wildly if interest rates change. So this all sounds pretty good, right? Fast, simple, and your house is safe. But as with anything in finance, there's no free lunch. The very things that make a personal loan so attractive are also the source of its biggest drawbacks. To really understand if it's the right tool for your project, we have to look at the good, the bad, and the downright ugly. Let's start with the good, the undeniable advantages. The number one reason people turn to personal loans is speed. Unbelievable, breathtaking speed. With a HELOC, you're looking at a 30 to 60-day process. There's an application, underwriting, an appraisal, a title search, a closing. It's a mini mortgage. With a personal loan, you can often go online, fill out a form in 10 minutes, get a decision in seconds, and have the cash in your bank account in 24 to 48 hours. Think about what that means in the real world. Your central air conditioning doesn't give you a 60-day warning before it dies in the middle of a July heatwave. A pipe doesn't schedule an appointment to burst and flood your basement. When you need money for an urgent, non-negotiable repair, the speed of a personal loan isn't a luxury. It's a necessity. The second major pro is that simplicity. Because there's no house involved, there's no mountain of paperwork. No appraiser scheduling visits, no digging up deeds, no title insurance fees. It's a clean, straightforward transaction between you and the lender. This also means the closing costs are either non-existent or baked into a single transparent origination fee, which we'll get to in a minute. And of course, the biggest pro for the risk-averse, your home is not collateral. This provides enormous psychological comfort. You can renovate your bathroom without feeling like you've just put your family's shelter on the poker table. Now for the bad. And this is a big one, the interest rates. Because the loan is unsecured, the lender is taking on 100% of the risk. If you don't pay, they have to chase you down. They can't just sell your house to get their money back. To compensate for that massive risk, they charge a higher interest rate. It's a risk premium. While a homeowner with good credit might get a HELOC at say 7 or 8%, a personal loan for that same person might be anywhere from 9% to 15% or even higher. If your credit is fair or poor, you could be looking at rates of 25% or more. That difference adds up to thousands, or even tens of thousands of dollars in extra interest over the life of the loan. The second drawback is the borrowing limit. You're not going to finance a $120,000 second-story addition with a personal loan. Most lenders cap out at around $40,000 or $50,000. Some might go up to $100,000 for borrowers with stellar credit and high incomes, but that's the exception, not the rule. This naturally limits the scope of the projects they're good for. They are designed for that mid-tier project. The bathroom remodel, the new deck, replacing all the windows, but not rebuilding the entire house. Finally, the repayment terms are much shorter. Typically, you'll find terms between 2 and 7 years. This is both a pro and a con. The shorter term means you're out of debt much faster. But it also means the monthly payments are significantly higher. Let's run a quick, simple example. A $30,000 loan. On a 15-year HELOC at 8%, your monthly payment is about $287. On a 5-year personal loan at 11%, your monthly payment is $652. That's more than double. Your monthly cash flow takes a much bigger hit. The flip side, with a personal loan, you pay about $9,100 in total interest and you're done in 5 years. With the HELOC, you pay over $21,000 in interest and you're still paying for that project a decade and a half later. Shorter term, higher payment but less total cost. Now let's talk about the ugly, the hidden traps you have to watch for. The biggest one is the origination fee. This is an upfront fee the lender charges for processing the loan. It typically ranges from 1% to 8% of the total loan amount, and it's deducted directly from the funds you receive. So you get approved for a $20,000 loan with a 5% origination fee. The lender takes their $1,000 cut right off the top. You only get $19,000 deposited in your bank account, but you're making payments on the full $20,000. This is why you must always compare loans using the APR, the annual percentage rate, not just the interest rate. The APR factors in these fees and gives you a true picture of the loan's cost. Another thing to watch for, though it's becoming less common, is a prepayment penalty. This is a fee the lender charges you if you try to pay off the loan early. It's their way of ensuring they get the interest payments they were counting on. Always ask the question directly. Is there any penalty for early repayment? If the answer is yes, you should probably look elsewhere. So, knowing all this, when does the personal loan become the hero of your home renovation story? There are a few key scenarios where it shines. First, for those emergency repairs we talked about. When speed is the most important variable, the personal loan is almost always the winner. Second, for the mid-sized, one-and-done project. You have a firm budget of $25,000 to redo your kitchen. You get a $25,000 lump sum, you have a fixed payment, and in 5 years the project is a distant, happy memory. There's no open line of credit tempting you to spend more. No variable rate keeping you up at night. It's clean. Third, it's perfect for the new homeowner. If you bought your house 6 months ago, you have almost no equity. You simply don't qualify for a HELOC or a cash-out refi. But if you need $10,000 to replace the failing furnace, a personal loan might be your only viable option. And finally, it's for the person who values peace of mind above all else. Someone who is simply unwilling to add a second lien to their home, no matter what. For them, paying a higher interest rate is a fair price for keeping their home's title clean and clear. So we have the heavyweight champion, the HELOC, powerful and deeply connected to your home's equity. And we have the agile challenger, the personal loan, lightning fast and completely unsecured. They seem like they operate in different universes solving different problems. But what happens when you put them in the ring together for the same exact project? What happens when a $50,000 home office edition is on the line? The numbers, the real hard numbers of monthly payments, total interest paid, and the impact on your net worth will shock you. And that's exactly what we're breaking down next. Let's get real. Forget the theories, forget the blog posts. We're going to use real numbers for a real American family. Let's call them the Millers. The Millers have a beautiful home, currently valued at around $400,000. They bought it a decade ago and have been diligent with their payments. They have $200,000 left on their mortgage, with 20 years remaining, at a fantastic interest rate of 3.5%. Their monthly mortgage payment, just the principal and interest, is about $1,160. Life is good. But with both of them now working from home permanently, their shared office in the spare bedroom is causing chaos. They need a dedicated home office edition. The contractor's quote comes in $50,000. It's a big number, but it's an investment in their careers and their sanity. So, they face the exact question we've been talking about. Option 1, the personal loan. They have great credit, so they shop around and get approved for a $50,000 personal loan. The best offer they find is an 11% interest rate, with a 5-year repayment term. It's clean. It's simple. The bank wires the money, they pay the contractor, and they start making payments. Using a standard loan calculator, their monthly payment on this loan comes out to $1,087. That's a hefty new bill each month. Over the course of 5 years or 60 payments, they will pay back a total of $65,220. That means the total cost of borrowing, the interest they paid to the bank for the convenience of getting that money up front, is $15,220. So, the $50,000 office really cost them $65,000. It's a lot, but it's a known quantity. In 5 years it's gone. Vanished. Their main mortgage, that beautiful 3.5% loan, remains completely untouched, chugging along in the background. Now for option 2, the cash-out refinance. The Millers hear an ad on the radio. Use the equity in your home. Get cash for the things you need. Sounds so tempting. They have $200,000 in equity, so getting $50,000 out should be easy. They call a lender. The lender says, "Absolutely, we can do that." But here's the catch, the one that's whispered in the fine print. Interest rates aren't 3.5% anymore. Today's best rate for a 30-year fixed mortgage is 6.5%. To get their $50,000, the Millers have to completely erase their old mortgage and take out a brand new one. Their new loan amount will be their old balance of $200,000, plus the $50,000 in cash they need. So, a new mortgage for $250,000. The lender draws up the paperwork for a new 30-year loan at 6.5%. Let's look at the monthly payment first, because this is the siren's song. This is the trap. Their new monthly payment, principal and interest, on that $250,000 loan will be $1,580. Now compare that. Their old payment was $1,160. Their new payment is $1,580. That's an increase of only $420 a month. Think about that for a second. The personal loan was over $1,000 a month. This is less than half of that. From a pure monthly cash flow perspective, the refinance looks like a slam dunk. A complete no-brainer. You get your office, and your budget only takes a $420 hit instead of a $1,000 hit. This is the exact reason millions of people make this choice. And it is, for most of them, one of the biggest financial mistakes of their lives. Because we haven't talked about the total cost. We haven't talked about the silent wealth killer. Total interest over the life of the loan. Let's peel back the curtain. With the personal loan, the total interest was $15,220. A clear, defined cost. Now let's look at the refinance. On their new 30-year mortgage of $250,000 at 6.5%, If they make every single payment for 30 years, the total interest they will pay is a mind-numbing $318,800. Let me say that again. $318,000. That's more than the loan itself. But to truly understand the damage, we have to compare it to their original path. If they had never done the refinance and just kept paying their original mortgage, they only had 20 years left. Over those remaining 20 years, they would have paid about $78,400 in interest. So, by choosing the refinance, they didn't just add the cost of the $50,000 project. They took on an additional $240,000 in future interest payments. They traded a $420 monthly convenience for $250,000 long-term cost. And it gets worse. We forgot about closing costs. A refinance isn't free. You have appraisal fees, origination fees, title insurance. It all adds up. A conservative estimate for closing costs is 3% of the new loan amount. 3% of $250,000 is $7,500. So, to even get their $50,000, they had to pay $7,500 right off the top. That money is either paid out of pocket, or more commonly, rolled right into the new mortgage, immediately adding to their debt and the interest they'll pay on it. So let's put it all on the table. The personal loan. A monthly payment of $1,087. It's painful for 5 years, but the total cost of borrowing is about $15,000. Their primary mortgage, their biggest asset builder, is protected, safe with its ultra-low interest rate. The cash-out refinance. A much more manageable monthly increase of $420. Feels easy, but it's a deal with the devil. It costs $7,500 in closing costs just to start, and it vaporizes their incredible 3.5% interest rate, replacing it with a 6.5% rate not just on the $50,000, but on their entire $200,000 debt. They reset the clock, turning 20 remaining years into a fresh 30. The ultimate result isn't just a new home office. It's a $250,000 donation to the bank in the form of extra interest. They've taken a short-term cash flow problem and turned it into a generational wealth problem. Seeing the numbers laid out like this, it's brutal, shocking, and it paints the cash-out refinance as a villain, a financial predator to be avoided at all costs. For the Millers, in this specific scenario, the personal loan is unequivocally the better choice. It's not even close. It protects their most valuable financial tool, their low-interest mortgage, and while it demands more discipline month to month, it saves them a fortune in the long run. But does this mean a cash-out refinance is always a bad idea? Is it never the right tool for the job? No. In fact, there are very specific situations, certain economic conditions, and particular types of projects where pulling equity from your home isn't just a good idea. It's a genius-level financial move that can accelerate your wealth far faster than leaving that equity locked up. The key is knowing how to tell the difference between a trap and an opportunity. And those specific, powerful scenarios are exactly what we're exposing next. Let's start with the clearest cut case for using your mortgage. The major, value-adding renovation. This isn't just spending money. This is strategic capital deployment. Imagine a homeowner. Let's call her Sarah. She lives in a great neighborhood, but her house is stuck in 1988. We're talking a closed-off kitchen with honey oak cabinets and laminate countertops. It works, but it's a time capsule. Sarah does her homework. She sees that renovated homes on her street, with open-concept modern kitchens, are selling for an average of $80,000 more than homes in her home's current condition. A contractor quotes her $65,000 for a full gut renovation. Tear down a non-load-bearing wall, install a big island, new quartz countertops, new appliances, the works. This is a big number. So what does she do? First, let's look at the personal loan option. For $65,000, even with excellent credit, she's probably looking at an interest rate around 12% for a 7-year term. The monthly payment on that would be over $1,000 a month. And over the life of the loan, she'd pay nearly $30,000 in interest alone. That's $30,000 that just vanishes into thin air. At the end of 7 years, she's paid a total of $95,000 for her $65,000 kitchen. Now let's look at the mortgage-backed option. Sarah has significant equity in her home. She decides to do a cash-out refinance. Let's say her current mortgage balance is $200,000, and her home is valued pre-renovation at $500,000. She refinances for a new loan of $265,000. She uses that to pay off her old $200,000 mortgage and gets a check for $65,000 in cash. Now, her interest rate might go up slightly from her old rate to the current market rate. But even so, that new rate will be dramatically lower than the 12% of a personal loan. Let's say it's 7%. And because it's spread over 30 years, her monthly payment increase is far more manageable than the $1,000 hit from the personal loan. But here's the most important part. The moment that renovation is complete, her home isn't worth $500,000 anymore. It's worth $580,000. She spent $65,000 to create $80,000 in value. She instantly manufactured $15,000 in net worth. She used the bank's money at a low tax-deductible interest rate to literally make herself richer. The personal loan with its high non-deductible interest would have eaten away almost all of that gain. In this scenario, using a mortgage isn't just a financing decision. It's an investment strategy. It's using leverage the way a corporation does to generate a return. For large projects with a proven, high return on investment, like a major kitchen or bathroom remodel or adding a bedroom, the mortgage-backed loan is almost always the financial weapon of choice. But that's not every project. So let's pivot to a completely different scenario. Meet Mark. Mark lives in an area that gets severe thunderstorms. One night, a massive gust of wind sends a huge oak limb crashing onto his roof. It punches a hole right through the shingles and the plywood underneath. It's not a full-on disaster yet, but water is dripping into his attic, and the next storm is just 2 days away. His insurance will cover a portion, but his deductible is high, and he needs $15,000 to get a crew out there tomorrow. This is not a time for deliberation. It's a time for action. What happens if Mark tries to get a home equity loan or a cash-out refi? He calls his lender. They say, "Sure, we can start the application." It requires an appraisal, income verification, underwriting. The process takes on average 30 to 60 days. 30 to 60 days. By then, Mark won't have a water drip. He'll have a new indoor swimming pool in his living room, complete with crumbling drywall and a 5-figure mold remediation bill. The cost of delay is catastrophic. Furthermore, the closing costs on a mortgage, which can be 2 to 5% of the loan amount, would be ridiculous for a small $15,000 loan. He might pay $2,000 in fees just to borrow $15,000. This is where the personal loan becomes a hero. Mark goes online, fills out an application in 10 minutes, and because he has good credit, he's approved almost instantly. The money, $15,000, is in his bank account in 48 hours. The interest rate might be 10% higher than a mortgage, yes, but he's not paying it for 30 years. He takes out a 3-year loan. His payment is manageable, and the total interest he'll pay is a couple of $1,000. But what did he buy with that interest? He bought speed. He bought the ability to prevent a $15,000 problem from becoming a $50,000 catastrophe. He used the personal loan as a financial scalpel, a quick, precise, targeted tool to solve an acute problem without the collateral damage of refinancing his entire home life. He contained the financial bleed. For urgent, time-sensitive repairs where speed is the most critical variable, the personal loan isn't just the better option, it's the only option. Now for the scenario that trips up almost everyone. The gray area. The lifestyle project. This isn't an investment like Sarah's kitchen, and it's not an emergency like Mark's roof. This is the $25,000 backyard patio and fire pit you've been dreaming of. It will add some value to your home, sure, but you're not doing it for the ROI. You're doing it for the summer barbecues and the memories. So how do you finance a want instead of a need? This is where your choice of loan becomes a test of your financial discipline. You could easily tap into a HELOC. The rate is low, the payment is small, it feels easy. Too easy. You're financing a lifestyle upgrade by extending the debt on your single biggest asset. You'll be making payments on that patio for 15 or 30 years, long after the pavers have settled and the novelty has worn off. It blurs the line between a home and an ATM, and that is a dangerous line to cross. Now consider the personal loan. For that same $25,000, you might get a 5-year loan at 11%. The monthly payment will be noticeably higher than the minimum payment on a HELOC. And this is a good thing. That higher payment forces you to ask the hard question. Can we truly afford this right now? It's an honest reflection of the project's cost. If that monthly payment makes you wince, that's your answer. It's a built-in reality check. Furthermore, it imposes an end date. In 5 years, the debt is gone. You're free. You can enjoy your patio for the next 20 years without still paying for it. This creates a powerful mental framework. Align the term of the loan with the primary benefit period of the project. A kitchen remodel benefits you for the life of the home. A 30-year mortgage aligns with that. An emergency repairs benefit is immediate. A short-term loan aligns with that. A lifestyle patio's primary newness and enjoyment payback is in its first 5 years. A 5-year loan aligns perfectly. Using a 30-year mortgage for a 5-year thrill is a fundamental mismatch that builds slow, insidious, and unnecessary debt. So we have the 3 core scenarios. The wealth-building investment, where a mortgage is your power tool. The emergency triage, where a personal loan is your scalpel. And the lifestyle test, where the personal loan provides the discipline that a HELOC so dangerously lacks. Understanding which scenario you're in is more than half the battle. But it's not the whole story. Because once you've chosen your loan, you have to navigate a minefield of hidden fees, tricky terms, and lender traps that are designed to take more of your money. And those traps are exactly what we're exposing next. The first and most common trap is the one hiding in plain sight, the origination fee. Sounds official, almost unavoidable. Lenders will tell you it's the cost of processing your application, of underwriting the loan, of doing the paperwork. But let's call it what it really is. It's pure profit. It's a fee for the privilege of taking out the loan. Think of it like a cover charge at a nightclub, but instead of getting you access to a dance floor, it gets you access to tens or hundreds of thousands of dollars in debt. This fee is almost always calculated as a percentage of the total loan amount, typically between 0.5% and 1%. On a $50,000 personal loan, 1% is $500. Annoying, but maybe you swallow it. But on a $200,000 cash-out refinance, that's $2,000. Gone. Evaporated before you even get the money. The trap isn't just that the fee exists, it's that many people assume it's non-negotiable. It isn't. You can and should always ask if the origination fee can be reduced or waived entirely, especially if you have excellent credit. Some lenders will trade a no-fee loan for a slightly higher interest rate. You have to do the math to see which is better, but never ever just accept that fee as a fixed cost of doing business. It's their business, not yours. Next, we have one of the most insulting traps in the entire financial world. The prepayment penalty. This is a fee the lender charges you for paying back your loan too early. Let that sink in. You are being financially punished for being responsible. It's like a landlord charging you a fee for paying your rent ahead of schedule. It makes no sense from your perspective, but from the lenders it makes perfect sense. They approved your loan based on a projection of how much money they would make from your interest payments over many years. When you pay it off early, you're cutting into their projected profits. So, they hit you with a penalty to recoup some of that lost interest. These penalties are especially common with certain types of mortgages and can be brutal, sometimes costing you thousands of dollars. They typically apply for the first few years of the loan. You absolutely must ask your lender point blank, is there a prepayment penalty on this loan? If they say yes, you ask for the details. How much is it? How long does it last? Does it apply if I sell the house, or only if I refinance with another lender? If you have any intention of moving, refinancing, or paying off your debt aggressively in the next 5 years, a loan with a prepayment penalty could be a financial time bomb waiting to go off. Now for the master of confusion, the difference between an interest rate and the APR. Lenders love to advertise a super low interest rate. It's the big shiny number on the billboard. But the interest rate is just one part of the cost. It's the sticker price of the car. The APR, or annual percentage rate, is the out-the-door price. The APR includes the interest rate plus most of the fees we're talking about, the origination fee, discount points, and other closing costs, all rolled together and expressed as a percentage. This is why the APR is almost always higher than the advertised interest rate. And this is the number you need to focus on. Comparing two loans based on interest rate alone is a rookie mistake. A lender could offer you a 6.5% interest rate that looks amazing, but then they load it up with $3,000 in fees. Another lender might offer a 6.75% rate, which seems worse but has only $500 in fees. When you compare the APRs, you might find that the second loan, the one with the higher interest rate, is actually the cheaper option over the life of the loan. The APR is the great equalizer. It's the standardized metric that cuts through the marketing fluff and shows you the true cost of borrowing money. Always compare APRs, not just interest rates. Let's move on to a trap that has burned millions of homeowners, especially with home equity lines of credit, or HELOCs. It's the seductive power of the teaser rate. A lender will offer you a ridiculously low introductory rate for the first 6 months or a year. Maybe 1 or 2%. Feels like free money. You start your big kitchen renovation, drawing funds from your HELOC, making these tiny manageable interest-only payments. It's fantastic. But that teaser rate is bait. Once the introductory period ends, your rate doesn't just go up a little bit, it skyrockets. It becomes a variable rate tied to a benchmark, like the US prime rate, plus a margin set by the bank. So if the prime rate is 8.5% and the bank's margin is 2%, your new rate is 10.5%. Your monthly payment can easily double or triple overnight. But the trap has a second layer. Most HELOCs have a draw period, usually the first 10 years, where you can borrow money and often make those low, interest-only payments. But after that, the loan enters the repayment period. You can no longer borrow money, and you must start paying back both the principal and the interest, usually over the next 15 or 20 years. People who got used to paying a few $100s a month during the draw period are suddenly hit with a 4-figure monthly payment, right when they might be thinking about retirement. It's a devastating 1-2 punch that can derail a lifetime of financial planning. Then there's the confusing game of points. When you hear a lender talk about points, they could mean one of two things, and you need to know the difference. First, there are discount points. This is where you pay the lender a fee upfront in exchange for a lower interest rate on your loan. 1 point typically costs 1% of the loan amount and might lower your rate by about 1/4%. The trap here is paying for points when you don't plan on staying in the home long enough to benefit. You have to calculate your break-even point. Let's say you pay $3,000 for points to lower your monthly payment by $75. You would divide $3,000 by 75, which gives you 40. It will take you 40 months, almost 3.5 years, just to earn back the money you paid up front. If you sell or refinance before then, you've just handed the lender a gift. The second type of point is an origination point, which is just another fancy name for the origination fee we already talked about. Lenders use the term points because it sounds more official and less like a simple fee. Always clarify. Are we talking about discount points to lower my rate, or origination points to process the loan? Don't let them hide a fee behind confusing jargon. Finally, there's the closing cost shell game. The origination fee is just the beginning. When you get a mortgage or a HELOC, you're presented with a long list of closing costs. There's the appraisal fee to determine your home's value, title insurance fees to protect the lender, attorney fees, recording fees for filing paperwork with the county, underwriting fees, tax service fees. The list goes on and on. Individually, they might seem small, a few $100s here, a few hundred there. But together, they can add up to 2 to 5% of your loan amount. That's an extra $4,000 to $10,000 on a $200,000 loan. The trap is that these fees can be a profit center for the lender. They might charge you $600 for an appraisal that only cost them $400. They might mark up the cost of a credit report. The key to defending yourself is to demand the official loan estimate form. Federal law requires lenders to give you this standardized document within 3 days of applying. It breaks down every single estimated cost in a clear, easy-to-read format. This form is your best friend. It allows you to easily compare offers from different lenders side by side, to see who is charging what for which service. It turns their shell game into a simple price comparison, so you know the traps. You see the landmines. But knowing they exist isn't enough. You need a step-by-step strategy to disarm them, a negotiation playbook that puts you in control. And that exact playbook, the word-for-word questions to ask and the red flags to watch for, that's what we're building in the final, most important part of this entire guide. Let's start with the foundation. Before you ever pick up the phone or walk into a bank, you need to become the most prepared applicant they have ever seen. This isn't about impressing them. It's about arming yourself. First, you need to know your 3-digit superpower, your credit score. Not a guess, not the number from some free app. You need your FICO score, the one most lenders actually use. A score above 740 puts you in the driver's seat. Below that, your mission is to understand exactly why, and fix any errors or late payments you can. Second, calculate your debt-to-income ratio, or DTI. This is the lender's holy grail. All you do is add up all your monthly debt payments, student loans, car payments, credit cards, and divide it by your gross monthly income. If that number is over 43%, you're a red flag to many lenders. Getting it under 36% makes you look like a financial rock star. Knowing this number before they do allows you to frame the conversation. And third, assemble your arsenal. Get your last 2 pay stubs, your last 2 years of tax returns, and your last 2 months of bank statements. Digitize them into a single folder. When you approach a lender, you're not a tire kicker. You're a serious, organized client ready to do business. This preparation alone changes the entire dynamic. Signals that you know the game. Now the most critical piece of prep. You must get pre-qualified offers from at least 3 different lenders before you start negotiating with any of them. One from a big national bank, one from a local credit union, and one from a reputable online lender. This is your leverage. Without a competing offer, you have zero power. With one, you have the ultimate power, the power to walk away. Okay, you're prepared. You're armed. Now it's time to engage. You're on the phone or sitting across the desk from a loan officer. This is where the playbook goes live. Here are the exact questions to ask in order. Question number 1. The opener. Don't ask, what are your rates? That's amateur hour. You say, based on my FICO score of your score and a loan amount of your amount, what is the absolute best annual percentage rate or APR you can offer me today? Let's break that down. You stated your strength, your score. You used APR, not interest rate, because APR includes most of the fees, giving you a truer picture of the cost. And you said today, which creates a sense of urgency and pushes them to give you a real number, not a vague range. Question number 2. The fee interrogator. After they give you the APR, you immediately follow up with, thank you. Could you please email me a full itemized breakdown of all fees associated with this loan? I want to see the origination fees, any application or processing fees, and specifically, I need to know if there is a prepayment penalty. This is non-negotiable. A low interest rate can be a smokescreen for thousands of dollars in junk fees. The origination fee, a percentage of the loan, is often negotiable. But the prepayment penalty is the real villain. It's a fee they charge you for being responsible and paying off your loan early. In today's market, you should almost never accept a loan with a prepayment penalty. It's a trap. Question number 3. The leverage play. This is where you use your homework. I appreciate that offer. I'm currently reviewing another term sheet from competitor's name that has an APR of slightly lower number and a lower origination fee. I prefer to work with you. Are you in a position to match or beat that offer? Notice the psychology here. You're not being aggressive. You're being transparent. You're complimenting them. I'd prefer to work with you, which makes them want to work to keep you. But you've also drawn a clear line in the sand, backed by a real competing offer. This is the moment where you find out if they truly want your business. Question number 4, and this is especially powerful with a bank or credit union where you're already a customer. The loyalty card. I've been banking here for a number of years. My checking, savings, any other accounts are all with you. Are there any relationship discounts or preferred rates available for long-term, loyal customers? Banks spend a fortune trying to acquire new customers. They don't want to lose good existing ones. You are reminding them that you are an asset, not just an application number. You'd be stunned how often a special, unadvertised discount suddenly appears when you ask this question. Finally, question number 5, the closer. Once you've gone back and forth, you end with this. I'm making my final decision by the end of the business day tomorrow. Based on our conversation, what is the single best and final offer you can put in writing for me right now? This does 2 things. It creates a firm deadline, stopping the endless back and forth. And it forces them to lay all their cards on the table. It's the ultimate call to action, and it signals that you are in complete control of the process. Now, as you execute this playbook, you need to have your radar on, scanning for the red flags that tell you to run, not walk away. Red flag number 1. The vague answer. If you ask for an itemized fee sheet and they say, oh, we'll get to that later, or it's all standard, that's a massive warning. They are hiding something. Transparency is not optional in lending. If they won't put it in writing, it doesn't exist. Red flag number 2. The pressure cooker. If a lender ever says, this incredible rate is only available if you sign in the next hour, hang up the phone. That's not a deal. It's a high-pressure sales tactic designed to stop you from thinking clearly and from shopping around. Legitimate offers are typically good for several days, if not weeks, to give you time to review the legally required disclosures. Red flag number 3. The bait and switch. This is the oldest trick in the book. They quote you a phenomenal rate over the phone to get you hooked. But when the official loan estimate document arrives, the APR is higher and new fees have mysteriously appeared. This is why you never commit to anything until you have the official standardized loan estimate in your hands. Compare every line item to what you were promised. And the biggest red flag of all, which we've mentioned but it bears repeating, the prepayment penalty. A lender who penalizes you for paying back your debt faster is a lender who does not have your best interests at heart. They see you as nothing more than a stream of interest payments, and they will punish you for trying to become debt-free. Avoid them at all costs. Look, the journey we've been on through this entire guide, it was never just about interest rates and loan terms. It was never just about a home equity loan versus a personal loan. It was about something much bigger. It's about shifting the balance of power. It's about transforming one of the most stressful financial decisions of your life into an empowering one. Every home project, whether it's the dream kitchen where your family will share meals for a decade, the home office that launches your new career, or the finished basement that becomes your kid's favorite place on earth, it all starts with a financial decision. And for too long, we've been taught to approach that decision with fear and uncertainty, as if we're asking for a favor. But you are not asking for a favor. You are a highly sought-after customer. You are bringing a valuable asset, your good credit and your reliable income, to the table. Lenders are competing for your business, not the other way around. This playbook, this entire guide, is your declaration of independence. It's the tool you use to build your home on a foundation of financial strength, not on a mountain of regrettable debt. It ensures that the joy of your new renovation isn't overshadowed by the stress of a bad loan. You now know how to assess your project's ROI. You know the precise mechanics of each loan type. You know how to prepare your finances and how to negotiate like a seasoned pro. You have the knowledge. Now all that's left is the will to use it. If this guide gave you even a single tool, a single piece of confidence to take control of your next project, then do me a small favor and hit that like button. It's the ultimate feedback that we're on the right track here. And for every single person who made it to the end, I have one question for you. What is the one project you are dreaming of? That kitchen island? That backyard deck? That master bathroom oasis? Drop it in the comments below. Let's fill the conversation with the incredible dreams we're all working to build. Let's inspire each other. Thank you for your time. Go build your dream. But more importantly, build it wisely.